Technical analysis helps us predict the future movement of the market. It relies on a few elements that you'll get to know closely in this chapter. What are trends, what types exist, and why do we need to find them? How to find the graph's support and resistance. What are price patterns, how to identify them, and what do they signal? Get to know the most important methods used by experts to predict the market direction. Let's begin. As explained previously, technical analysis strives to identify recurring patterns in order to predict future price movement. A technical analyst is guided by the market itself and attempts to predict the future based on the past. He's not interested in the factors underlying the price's behavior. Identifying the direction of a trend is one of the most important tools in technical analysis and enables us to know which direction we should trade in. First, let's explain what a trend is. Well, a trend is a combination of waves that create the market's direction. Trends do not move in a linear downwards or upwards direction. Rather, they are hidden between the lines of the chart, requiring us to identify them on our own. There are three possible directions a chart can move in: up, down, and sideways. We identify a trend using peaks and troughs. Uptrend. An asset in an uptrend creates a series of increasingly higher peaks and troughs. Downtrend. An asset in a downtrend creates a series of increasingly lower troughs and peaks. Ranging trend. An asset in a ranging trend creates a series of peaks and troughs at price levels that are more or less identical. It's important to remember that when creating the trend line, we can also use the slope of the trend to determine the trend's strength. The steeper the slope is, the stronger the trend. Long-term trend. This trend is also called a major trend and is measured in years. This type of trend controls the asset over the longest time frame and is determined by fundamental factors. In order to identify a long-term trend, we also need to find the medium-term trend since they both move in the same direction. Medium-term trend. This trend is also called the secondary trend. This trend is more sensitive than the long-term trend since it covers shorter time frames. This trend is influenced by economic factors, but to a lesser degree than the long-term trend. Short-term trend. This trend is also called the minor trend. This trend is much more sensitive than the long-term and medium-term trends. The short-term trend is the most volatile of all and is most influenced by the day's news. Synchronization of all time frames. The most profitable trading opportunities arise when the trends of all three time frames are moving in the same direction. On this chart, you can see the long-term trend, the medium-term trend, and the short-term trend. You can see that at this point, all three trends are moving in the same direction, so the chances that the chart will continue moving in that direction are higher. In order to see the full picture, we need to find the support and resistance levels. The foundation of technical analysis rests on identifying support and resistance levels. Support and resistance are like a floor and ceiling that restrict the price movement from above and below. A support level is a price level at which the asset tends to stop moving downwards and then reverses direction and starts moving back up. The support level is represented in the diagram by a horizontal or near horizontal line that connects several troughs. The more troughs on the same price level, the stronger the support level. Usually, when a breakout of a strong support level occurs, the trend reversal can be expected, with the price continuing to move in the direction of the new trend. Support levels are created in the following cases. Traders decide that the current price is attractive for opening a new long trade. Traders decide that the current price is attractive for increasing the size of an existing trade. Traders who sold the asset decide that the current price is attractive for realizing their profits. A resistance level is a price level at which the asset tends to stop moving upwards and then reverses direction and starts moving back down. The resistance level is represented in the diagram by a horizontal or near horizontal line that connects several peaks. The more peaks on the same price level, the stronger the resistance level. The stronger the resistance level, the stronger the breakout will likely be when the price eventually does break through the resistance line. The start of a breakout is an excellent point to enter a trade. Resistance levels are created in the following situations. Traders decide that the current price is attractive for opening a new short trade. Traders decide that the current price is attractive for increasing the size of an existing trade. Traders who bought the asset decide that the current price is attractive for realizing their profits. Support and resistance levels are displayed on the chart in different forms: horizontal and diagonal. Horizontal support and resistance levels. These are the easiest kind to identify. They are created when an asset moves up and down inside the same price range. A resistance level that gets broken through usually becomes a support level. The reverse is also true. A support level that gets broken through usually becomes a resistance level. Diagonal support and resistance lines are more difficult to identify and are created when an asset's price rises and falls in a staircase pattern. In cases of an uptrend, these patterns create increasingly higher points and troughs, while in cases of a downtrend, the peaks and troughs become increasingly lower. Diagonal support levels indicate the trend's direction. In order to obtain a particularly effective indicator, it is recommended that both horizontal and diagonal levels be analyzed together. A price pattern is a series of candlesticks which indicate the possibility of a trend, as well as market volume and general structure. Pattern identification is a common technique used by many traders and helps in identifying reversals in price direction. The following are a number of price patterns. Head and shoulders. This is considered one of the most reliable and well-known patterns. The pattern indicates the end of a trend and includes a peak that is surrounded on both sides by lower peaks, more or less of the same height. In an uptrend, this pattern provides an important, reliable sign indicating the end of the current trend and the beginning of a new one. A support line is drawn below the three peaks, which serves as the base of the pattern and is called the neckline. In many cases, the pattern appears in reverse and indicates the end of a downtrend. Double top. This pattern is created when the price climbs to the same price level that established the previous peak. This pattern is considered less reliable than the head and shoulders pattern. In order to increase the reliability of the pattern, a time frame of at least 1 week should exist between the two peaks. Double bottom. This pattern is created when the price falls to the same price level that established the previous trough. Key reversal. This pattern includes 3 criteria. In an uptrend, at least 3 consecutive rising candlesticks preceding the pattern candlestick. The length of the pattern candlestick's shadow must be at least as long as the length of its body. The closing price of the pattern candlestick must be lower than the closing price of the preceding candlestick. Pennant pattern. The original direction of the pennant pattern indicates the trend's expected future movement. The pennant itself represents a ranging period that is created immediately after the steep trend that created the pennant's pole. The boundaries of the trading tunnel, the pennant itself, are created by the support and resistance line, which are parallel to one another, or slightly converged, creating the shape of a pennant or flag. An upwards pennant pattern is called a bullish pennant, while a downward pennant pattern is called a bearish pennant. The length of the pennant's pole can be used to estimate the exit target level. The pennant's pattern is considered to be a reliable pattern with 80 to 85% chances of success. Triangle pattern. Technical analysis recognizes 3 types of triangles. Bullish triangle. In this pattern, the lower side of the triangle slopes upwards while the top side is horizontal. 80% of the time, the breakout from this triangle pattern will occur in an upwards direction. Symmetric triangle. In this pattern, the 2 sides of the triangle are sloped towards one another in a convergent shape. In 60% of cases, the breakout that occurs from this triangle will continue the original direction of the trend. Bearish triangle. In this pattern, the upper side of the triangle slopes downwards while the top side is horizontal. In 80% of cases, the breakout from this triangle will occur in a downwards direction. In this lesson, you've learned the basics of technical analysis and how it practically affects your trading. You've also learned the most common and basic price patterns. In the next lesson, we'll delve deeper into technical analysis.